Viv Govendor, a senior analyst at Lehumo Capital, joins me now to help us make sense of all the financial data released today. Viv, thanks for your time today. Let's start with manufacturing. Any surprises on that 0.5% contraction?
We expected a contraction. In fact, we expected a bigger contraction, so it was slightly positive in that it was bad news, but not as bad as been expected.
Yeah.
Look, I mean, with the kind of issues having with electricity in the country, etc., versus last year, you would expect some pressure. It's rather sad to see, however, that despite the fact that we have what are generally favorable conditions, or should be favorable conditions, including a weaker currency, the manufacturing sector is still under pressure.
And that's the point, that it's unable to take advantage of the current situation with the exchange rate. So can we really just put that to the electricity shortages?
To a certain extent. I mean, of course, to another extent, a lot of the manufacturing we do in the country is based on our raw materials. Yeah. So the weaker currency actually makes our raw materials more expensive in round terms. So unless you have some kind of, development pricing that the government wants to put in play, whenever the currency weakens, the raw materials that we use for a lot of our manufacturing become more expensive in round terms.
This does not bode well then for economic growth, I suppose, in terms of manufacturing's contribution to it.
Yeah, and manufacturing is, I think, the most essential part of the economy. You can't have the majority of people working on the farms or working, I think, in the high-tech sector. It's if you wanted to really do something with the unemployment rate, especially the unskilled unemployment, you have to do something in the manufacturing sector. And the fact that we're seeing the sector under such pressure is a negative, not just for economic growth overall, but for the kind of growth that we want.
A bit of a positive on mining production. I mean, is that just off the low base of the strike that we saw last year?
I think it is off the low base that we are seeing coming through. And in fact, the mining sector is also under pressure. If you look, for instance, at the commodity prices that we're seeing now versus last year, it's very negative. And some of the news we're getting out of places like China and other parts of the world that are demanding commodities, it's it's rather negative. And even the actions that we're seeing from companies like BHP Billiton and some of the other manufacturers, producers of mining goods out there, is not positive for our mining sector, because at the moment there isn't any kind of consolidation. There is more a case of they want to protect market share, they want to increase production, because lower prices mean lower revenue. Therefore, we must increase production to make up for that lower revenue.
Gold mining still quite a drag. I mean, we seem to be moving lower and lower and lower on the scale of output, global output in South Africa.
Yeah, look, I mean, we've been mining for longer than virtually anybody out there. It's for, well over 100 years. And at one point in time, yes, we were number one, but the trend has been for quite a number of years now, quite negative. That's not to say that the gold manufacturing sector is, totally out of business in this country. If you look at, for instance, Sibanye Gold, they've managed to do rather well in this sector, but they aren't looking at expanding production. They're more looking at how to basically make the most out of diminishing assets.
Yeah. Iron ore, among the metals that have were bigger contributors in terms of output. Concern, of course, with where the prices are, and the news out of China today that they're going to give tax cuts to their own iron ore manufacturers. One wonders where that price is going to go.
Yeah, look, the problem is that the actual cost price of iron ore is rather low. It's been coming down quite dramatically, and if you look at where it was like a while back, we look at $150 per ton. Now it's like close to 50. And in fact, the matter is we're still quite a bit above the cost level for some of these production in Australia and other parts of the world. And in fact, the lower oil prices actually made it more competitive, because places like Brazil suddenly become more competitive because they can actually ship to China at a cheaper rate. And the problem is that none of these manufacturers or producers of iron ore are coordinating their production. They're virtually saying, if we were to drop our production to actually try and boost prices, someone will just step in and take up that production. So there's no coordination, and therefore I expect prices to still be under pressure for quite some time. So
for your outlook then for metal prices?
Unfortunately, the iron ore prices are probably going to be under pressure, because there's virtually going to be a price war, like we're seeing to a certain extent in the oil sector, a price war between the different producers out there trying to drive the higher cost producers out. But like you mentioned, the higher cost producers were generally the Chinese producers, but now they're getting a bit of government help, as you would expect from China.
Yeah, all right, we'll leave it there. Thanks for your time today. Viv Govendor is a senior analyst at Lehumo Capital.